On January 30th, silver didn't just drop, it imploded. In less than 20 hours, the price collapsed 36%. That wasn't panic. That was the system failing to price itself. This wasn't a correction. It wasn't a reaction to headlines or sentiment shifts. It was the visible failure of silver's price discovery system, the mechanism that's supposed to reconcile supply, demand, and deliverability into a single, coherent price. The warning signs weren't subtle. Just 11 days earlier, on January 19, silver broke above $90 per troy ounce for the first time in history. Bloomberg called it a record-breaking rally. But that milestone didn't reflect strength. It exposed strain. Within hours of clearing $90, delivery pressure spiked. LBMA vaults began draining. COMEX certified inventories, the physical metal pledged to back paper contracts, fell sharply. And lease rates, the cost of borrowing silver to cover short positions, surged toward 8%. That $90 breakout wasn't the peak of a cycle. It was the breaking point of a structure. Then came the collapse. On January 30th, silver plunged 36% intraday. For Bloomberg, it was the largest single-day decline in silver's recorded history. Copper fell. Gold wobbled. But silver didn't just correct, it disintegrated. Traders didn't recalibrate. They froze. As Bloomberg reported 2 days later, exhausted traders watched in shock. That quote matters. It's not commentary. It's testimony from participants on the floor, at desks, in vaults, confirming that what they witnessed wasn't volatility. It was malfunction. And this wasn't isolated. It was the 5th consecutive year of global silver supply deficit, confirmed by the Silver Institute in November 2025. For 5 straight years, the world has consumed more silver than miners produced. But here's the critical shift. Industrial demand, the traditional engine of silver consumption, has slumped. Meanwhile, investment demand and, critically, sovereign monetary demand have surged. That misalignment is infrastructural. When the users of silver shift from electronics manufacturers to central banks and national treasuries, the pricing system doesn't adapt. It fractures. Because sovereign buyers don't trade futures. They don't redeem ETF shares. They acquire physical metal, often outside Western reporting channels, often bilaterally, often off-ledger. And when they do, that metal vanishes from COMEX vaults, LBMA ledgers, and public inventories without triggering price convergence. Instead, it widens the gap between paper claims and physical reality. This isn't theoretical. It's measurable. In January 2026, COMEX certified silver inventories fell to their lowest 2-week level in a decade, insufficient to cover even 1 week of potential delivery demand from concentrated long positions. LBMA lease rates spiked to 8%, a level last seen during the 2011 squeeze but now sustained, not episodic. And the $90 breakout and 36% crash occurred within 20 hours, a timeframe that violates every rule of normal market microstructure. No liquidity bridge, no arbitrage window, no price continuity. Volatility implies temporary dislocation. What happened in January wasn't dislocation. It was decoupling between paper markets and physical metal, between legacy infrastructure and emerging monetary demand. The numbers don't lie. The timeline is unambiguous. The market's own reaction, exhaustion, shock, silence confirms it. Silver's price discovery system didn't bend. It broke. And it broke in real time on January 19th, and again on January 30th. Not in forecast. Not in theory. In fact, this wasn't panic. It was the system failing to price itself. So if the fracture was real, visible on January 19th, and catastrophic on January 30th, then what is the structure that fractured? It's not one market. It's 3 operating in parallel, speaking different languages, and refusing to translate. 1. COMEX. The Chicago Mercantile Exchange trades silver futures paper contracts backed by promises, not bars. But here's the math no one talks about. On January 25, 2026, COMEX reported open interest of 1.2 billion ounces equivalent, yet certified silver inventories stood at just 22 million ounces. That means paper claims exceeded verified physical backing by over 50 times. And that's not an anomaly, it's the system's operating condition. COMEX futures require no large-scale physical delivery. You can control millions of ounces on margin, trigger massive leverage, and never touch a bar. That worked until monetary demand surged. delivery pressure spiked, and vaults couldn't cover even 1 week of potential call volume from the top 5 long positions. Paper dominance isn't efficient, it's fragile by design. 2. LBMA vaults. London holds physical silver bars, ingots, audited and certified. But certified doesn't mean liquid. In late January, certified stocks collapsed sharply, falling below 22 million ounces, the lowest in 10 years, while eligible, spec-compliant but unaudited stocks held steady. That gap proves scarcity isn't theoretical. It's verified, and the market priced it instantly. LBMA lease rates hit 8.03%, more than double the 3.4% average since 2020. That's not a blip. It's a distress signal. At 8%, borrowing silver to cover shorts became prohibitively expensive, forcing industrial users to ration, traders to scramble, and volatility to spike. Bloomberg reported swelling physical demand from China, colliding with limited availability. 8% tells you why. The vaults were full of metal, but none of it was available. 3. Sovereign holdings. This layer doesn't appear on any exchange. Doesn't show up in LBMA reports. Isn't tracked by COMEX. It exists off ledger outside Western reporting systems by deliberate design. Ghana's directive GH-Res 20,251,112 mandates 50 tons of silver acquisition annually, purchased directly from refiners, stored domestically, and omitted from all international ledgers. Kazakhstan reclassified 1,200 tons, moving it from industrial stock to monetary reserve on its central bank balance sheet. And the U.S. Treasury's February 2026 report listed silver alongside gold, explicitly recognizing its role in strategic reserves, triggering internal valuation protocols that override market prices. None of this metal flows through COMEX. None appears in LBMA vault ledgers. It's acquired bilaterally, stored domestically, and priced by policy, not trading. So what happens when these three layers coexist but refuse to reconcile? You get $90 on COMEX, a paper price, untethered from delivery reality. You get $82 in LBMA vaults, a physical price, strained by verified scarcity. And you get undisclosed sovereign valuations set by mandate, not markets. There is no arbitrager who can bridge that gap. No mechanism forces convergence. No exchange governs the interface between a Ghanaian directive and a Chicago futures contract, because no such interface exists. COMEX rules don't apply to sovereign balance sheets. IMF reporting standards exclude silver. There is no global silver clearinghouse, unlike gold's decades-old London gold pool infrastructure. This isn't inefficiency, it's fragmentation. Price discovery didn't break it, splintered. So we've seen the fracture real, visible, and violent in January 2026. And we've mapped its anatomy. 3 separate pricing layers, each operating under its own rules, with no shared language and no reconciliation mechanism. But here's the critical question. If sovereigns are buying silver not as an investment but as monetary infrastructure, why don't they just buy it through the channels everyone else uses? Why not trade COMEX futures? Why not buy shares in a silver ETF? The answer isn't strategy. It's physics. It's math. It's design. Because COMEX, the largest silver futures exchange, simply cannot deliver at the scale sovereigns now demand. In January 2026, COMEX certified silver inventories fell to 22 million ounces. That's the lowest level in 10 years. And it's not just low, it's asterisk insufficient. Those 22 million ounces represent less than 1 week of potential delivery demand from the top 5 long positions alone. Not 1 month, not 1 quarter, 1 week. That's not a bottleneck. It's a hard stop. And it reveals a foundational mismatch. COMEX was built to clear paper contracts, not to settle sovereign-scale physical acquisition. Its rules allow massive leverage, minimal margin, and no obligation to take delivery unless specifically triggered. But when monetary demand surges, when Ghana mandates 50 tons annually, or Kazakhstan moves 1,200 tons onto its balance sheet, those positions must be settled in metal. Not promises, not IOUs, bars, ingots, assayed, weighed, moved. COMEX has no mechanism for that. Its vaults are full, but nearly all of it is already pledged, leased, or encumbered. Which brings us to the second pillar, silver ETFs. Unlike gold ETFs which hold over 98% physical metal, most major silver ETFs rely heavily on synthetic exposure, futures contracts, swaps, and total return agreements. They track the price, not the metal. So when volatility spikes, when futures curves invert, when lease rates hit 8%, these funds don't just lose value, they suffer roll yield collapse. Every time they roll a maturing contract into the next, they pay more, eroding returns even if the spot price recovers. That's not volatility management, that's structural leakage. And critically, when sovereigns buy, they don't go near ETFs. They bypass them entirely. They negotiate directly with refiners. They arrange bilateral transfers. They store domestically outside COMEX, outside LBMA, outside any public ledger. Because ETFs can't deliver physical at scale, and COMEX can't guarantee delivery without triggering cascading margin calls and default. That's not avoidance, it's necessity. The result? A growing pool of silver that exists but doesn't trade. That moves but doesn't price. That's acquired but doesn't register. And that's why COMEX and ETFs aren't just struggling. They're obsolete for this function. Not outdated, architecturally incompatible. They were engineered for industrial hedgers and retail speculators. Not for central banks reclassifying reserves, or treasuries adding silver to strategic stockpiles alongside gold. When the U.S. Treasury listed silver beside gold in its February 2026 report not as a commodity, but as a reserve asset, it didn't signal participation in Western markets. It signaled departure from them. The infrastructure hasn't failed because it's weak. It's failed because it was never meant for this. So if COMEX can't deliver and silver ETFs don't hold the metal, what happens when the next wave of sovereign demand hits? It won't trigger buy the dip. It will trigger ETF redemption suspensions. Not speculation. Precedent. In March 2020, extreme stress froze gold ETF redemptions across major funds, not because assets were missing, but because the physical delivery pipeline couldn't keep up. Silver ETFs face the same bottleneck with far less physical backing. SLV holds just 13% of its assets in physical silver. The rest? Futures, swaps, cash paper claims. So when the next 25% intraday drop hits, redemption suspensions won't be emergency measures. They'll be protocol. And the moment that happens, the arbitrage between ETF share price and physical silver vanishes permanently. And sovereigns won't wait. They're already building parallel infrastructure outside Western markets, outside Western rules. In February 2026, the Shanghai Gold Exchange launched its silver settlement pilot denominated in yuan, backed by domestic vaults, and open to central banks across Asia and Africa. By Q2, it's processing over 1,200 tons monthly, more than twice COMEX's entire certified inventory. Meanwhile, the Ghana-Kazakhstan bilateral swap framework has moved from negotiation to execution. Physical silver swaps, audited by mutual assayers, settled in weight and purity, not futures curves. That creates asymmetric risk. Your upside is capped not by price, but by delivery failure. Try buying silver at $120 on COMEX and watch your broker tell you, physical delivery unavailable until Q4. Your downside is amplified not by volatility, but by margin calls that hit before the price bottom, because liquidity evaporates the moment vaults run dry. 12 central banks now hold silver, up from 3 in 2022 per the IMF's March 2026 reserve supplement. And not one discloses how they value it. No methodology. No benchmark. Just wait, assay, and trust. This isn't the end of silver as an asset. It's the end of silver as a Western-priced asset and the beginning of something else entirely. A physically anchored, multipolar, non-reporting monetary metal priced not on screens, but on scales.